Hello students, welcome to all of you Shiksha 360 CAP classes. Today basically we have to discuss regarding the chapter number 25 of ABFM. That is regarding the SPAC. Clear? First question basically which you will expect in your examination. What is SPAC? SPAC basically stands for the Special Purpose Acquisition Companies. Clear? So SPAC basically stands for the Special Purpose Acquisition Companies. So what is that? There are some other points in that first few slides that is very important for the examination point of view, and some MCQs I have already uploaded in the group, so you can go through that. So a company that does not carry any commercial operations and is incorporated or established, we can say that, purely basically for the purpose of raising capital. Clear? Basically for what purpose? Basically for the purpose of raising capital. Basically through which process? Through the IPO, that is initial public offerings, or is incorporated basically for the goal of acquiring or merging basically with an existing company, that is to be known as the special purpose acquisition company. Clear? That company basically it is to be known as the special purpose acquisition company. Further, basically when this term it is to be first introduced, so they came first, or they first came into existence in the 1980s during a time when they were poorly regulated, and as a consequence investors lost money due to the fraud. Okay, after that this term originates. So black check companies, BCC, very important. This is the another question. Clear? What is the another name of the SPAC? That is BCC, that is black check companies, is the another name for these businesses. The Indian regulatory framework does not allow the creation of black check companies. The Companies Act 2013 further stipulates that the registrar of companies can strike off a company if it does not commence its operation basically within a 1 year of incorporation. Clear? Basically if any company does not start its operations basically within 1 year of its incorporation or registration, then they can strike off a company. Recently, Renew Power, an Indian company, had a business transaction for combining with a company situated in the United States called RMG Acquisition Corporation 2, which is a SPAC or a black check company. Clear? Renew Power, that is an Indian company. They basically for what purpose they have established or incorporated? Basically for combining with the company that is situated in another country. Clear? Like we can say that in the US called RMG Acquisition Corporation 2, which is a SPAC or a black check company. Now further that is the Indian regulator company. Sorry, this is we have already covered. So after the transaction, the combined company was renamed. Clear? Basically when both the companies are merged with each other or combined, that is a new name, that is Renew Energy Global PLC, and was publicly listed on NASDAQ, on the stock exchange of US. This is the first major overseas listing of an Indian company. Clear? This is the first major overseas listing of an Indian company via the SPAC. Videocon D2H. Videocon, it is a separate company. D2H, it is a separate. Clear? And online travel agency Yatra earlier had SPAC detail. Clear? So these are some of the example. Like first one, that is the Videocon D2H. Online travel agency like Yatra. Clear? They had also SPAC deals. Now move further. So because of the flexibility of SPACs to attract the industries based on the changing market fundamentals, and also because SPAC IPO investors have the downside protection of redemption decisions, SPACs have been recently become very popular as a result of the market disruption caused by the COVID-19 pandemic. Clear? Because after the COVID-19 pandemic, there is a lot of market disruption it is caused here. This is one of the reasons why SPACs have become so popular. Remember these figures, also numerical values. Sometimes they will ask question. So in 2019, there were just 59 new SPACs introduced to the market with an investment of $13 billion. SPACs investors basically can be private equity funds or even well-known figures in the public eye. they have a deadline of 2 years to successfully complete a purchase. If they will miss it, they will be required to repay the money to the investors. They're like basically for any specific purpose. They have raising the money basically from the public. And if they're not able to meet or basically not able to do that purchase successfully or complete their target, so they have to be repay the money back to the investors. Okay. So they have a deadline of 2 years to successfully complete a purchase. If they miss it, they will be required to repay the money to the investors. Further, that is SPACs are the organizations that are formed by the investors or sponsors who have experience in a specific industry or business sector with the purpose of clear. So SPACs basically are the organizations that are formed by the investors or sponsors who have experience in a specific industry or business sector with the purpose of pursuing business opportunities in that field. Clear? Basically, with what purpose? Basically, with the purpose of pursuing business opportunities, basically in that field. In most of the cases, the investors have at least one acquisition target in mind at the time of company's establishment. Okay. However, that is basically that is acquisition target in mind at the time of the company's establishment. However, this information it is not disclosed at the time of the IPO in order to streamline the disclosure process. Clear? Later on, basically it will be disclosed. Clear? However, this information clear basically where they will go merging or basically combined. Clear? However, this information it is not disclosed at the time of the IPO in order to streamline the disclosure process. So further, that is before issuing their shares to the general public through the IPOs, SPACs must first get underwriters and institutional investors. The money that are collected by the SPACs are placed in a trust account. Clear? First of all, the money basically that are collected by the SPACs, special purpose acquisition companies, are first placed in a trust account that earns interest on the funds. These funds can only be used for acquisitions or in the event that the SPACs is dissolved for the purpose of returning the money to the investors. Clear? Why? Basically, if they are not utilizing these funds, so they are able to return the money. In a select few instances, the interest that is accrued or earned from the trust account may be applied towards the aim of providing the SPACs basically with working capital. Working capital that is basically for performing day-to-day work. Further, that is after the acquisition has completed, an SPAC basically will typically apply to be listed on one of the stock exchanges. Like we have discussed, that is Renew. When combining with the US company, they will be listed on NASDAQ. Next one. Not every SPAC will be successful and accomplish their milestone goals. In fact, some of them will fail entirely, causing investors to lose their investment capital. Clear? Not every SPAC will be successful and accomplish their milestone goals. In fact, some of them basically will fail entirely and causing investors to lose their investment capital. So despite this, they plan to continue operating in the sector since they provide investors and targets with new alternatives for funding that are in direct competition basically with the later stage venture capital. What is venture capital? I will also cover in the upcoming session. Clear? So despite this, they plan to continue operating in the sector since they provide investors and targets new alternatives for funding that are in direct competition with the later stage venture capital, private equity, direct listing, and the traditional IPO process. They result in an influx of capital for a range of new businesses and other enterprises, which in turn fuels innovation and business expansion. Clear? Basically, which in turn fuels innovation and business expansion. Okay. So they result in an influx of capital for a range of new businesses and other enterprises, which in turn fuels innovation and business expansion. So that is a basic introduction regarding the SPAC, that is special purpose acquisition companies. Next one further. So it is possible that India will launch its own blank check form, black check companies like we have covered in the near future. The market regulator SEBI is likely to permit the listing of special purpose acquisition companies much as they do in the United States. The SEBI is a reporter to inform the Parliamentary Standing Committee, PSC, according to news reports published in the May 2022, that the subgroup of the Principal Market Advisory Committee, PMAC, Principal Market Advisory Committee, is in the process of finalizing the report on SPACs. After that, a consultation document on the topic that invites feedback from the general public might be distributed. Consultation with the PMAC is required before any action can be taken respecting the SPAC's framework. Okay, so they have submitted their report also to the Parliamentary Standing Committee. The Company Law Committee report of the Ministry of Corporate Affairs for February 2022 advocated the introduction of an enabling provision to recognize SPACs under the Companies Act. Clear? So the Company Law Committee report of the Ministry of Corporate Affairs, basically for the February 2022, advocated the introduction of an enabling provision to recognize the SPACs under the Companies Act and allowing a SPAC formed in India to trade on domestic and global markets. Clear? Further, that is, and allowing the SPAC formed in India to trade on the domestic and global markets. So now next one, that is, what are the advantages of the SPACs? So when compared to an initial public offering, going public through a SPAC merger has the following primary advantage. First one, that is the speedier execution. A SPAC merger typically takes place within 3 to 6 months. Clear? So within how much time basically it will take place? Within 3 to 6 months on average. But an initial public offering often takes place between 12 and 18 months to complete. Clear? IPO basically takes place, basically SPAC merger basically typically takes place 3 to 6 months. On the other side, basically IPO often takes place basically between 12 to 18 months to complete. Second one, that is the discovery of the price upfront. Clear? Discovery of the price upfront. So while the price of your IPO will be determined by the state of the market. Clear? While the price of your IPO will be determined by the state of the market at the time of listing, you will negotiate the price with the SPAC before the transaction it is to be finalized. Clear? So while the price of your IPO basically will be determined by the state of the market at the time of listing. Further, that is, you will negotiate the price with the SPAC before the transaction it is to be finalized. This is a far more favorable strategy in an unstable market. Clear? That is discovery of the price upfront. Clear? That is negotiation it is to be possible here. Third one, that is the possibility of raising additional capital. Clear? The possibility of raising additional capital. SPAC sponsors will raise debt or PIPE. Very, very important. What is the full form of PIPE? Private investment in public equity. Clear? SPAC sponsors will raise debt or PIPE, that is private investment in public equity funding, in addition to their initial capital, in order to not only finance the transaction, but also to fuel growth for the combined company. Clear? In addition to their initial capital, in order to not only finance the transaction, but also fuel growth for the combined company. PIPE basically stands for the private investment in the public equity. Even in the event that certain SPACs investors decide to cash out their shares, it is still expected that the transaction would be successfully concluded thanks to the backstop debt and equity. Clear? Thanks to the backstop basically debt and equity. That is possibility of raising additional capital to the PIPE. Debt, that is, we can say that basically through the loan, or PIPE, that is private investment basically in the public equity. Fourth one, reduced marketing cost. Decreased costs associated basically with the marketing as a result of the fact. Clear? Decreased cost basically associated basically with the marketing as a result of the fact that SPAC merger. Clear? That SPAC merger, it is not required. Clear? That SPAC merger basically it is not required to attract interest from the investors in the public exchanges. Clear? Decreased cost associated basically with the marketing As a result of the fact that a SPAC merger, it is not required to attract interest from investors in public exchanges by means of a comprehensive roadshow. Clear? By means of a comprehensive roadshow. Fifth one, that is ease of access to specialized operational knowledge. Clear? Ease of access basically to the specialized operational knowledge. The individuals that sponsor SPACs are typically seasoned business and financial experts. Clear? So the individual basically that sponsors SPACs are typically seasoned business and financial experts. They can provide their managerial knowledge by drawing on their extensive network of contacts. Clear? They can provide their managerial knowledge by drawing on their extensive network of contacts, or they can volunteer to serve on the board themselves. Clear? Or further, we can say that, or they can volunteer to serve on the board themselves. Clear? So these are some of the basic advantages of the SPAC. First one, that is the speedier execution, that is discovery of the price upfront, possibility of raising additional capital either through the debt or through the pipe, reducing marketing cost, or ease of access to the specialized operation knowledge. Like we can say there are different organizations. Clear? And here that is, we can say that like some seasoned business or financial experts. Clear? So basically there is a merging of two will be, or combination of two different organizations basically will be possible, so that they can compete with the market. Clear? So that they can compete with the market with the present knowledge. Okay, this is the fifth point. The individuals that sponsor SPACs are typically seasoned business and financial experts. They can provide their management knowledge basically by drawing on their extensive network of contacts, or they can volunteer to serve on the board themselves. Next one, that is SPAC formation and the timelines. We will discuss also in detail here. So the initial public offering of a special purpose acquisition company, it is typically predicted on an investment thesis that is concentrated on a particular industry and geographical region as per their requirement, such as the intention to acquire a technology company in the North America, or the experience and history of a sponsor. After the initial public offering, just you can know that basically raising funds from the market, the proceeds are deposited into a trust account, and the SPAC normally has between 18 and 24 months to find and finalize a merger basically with the target firm. This process, it is frequently referred to as the de-spacing. Clear? What this process is to be known as a de-spacing. Initially establish the SPAC, then it is going to be merged. So in the event that SPAC is unable to accomplish a merger within the specified amount of time, the SPAC basically will be liquidated, and the profits from the IPO basically will be distributed back to the public shareholders. Clear? If they are not able to find their goal, so they will return the money to the investors. So the public shareholders of the SPAC have the option to vote against the deal once a target firm has been found and the announcement of a merger has been made. So further, they have the option, that is they want to retain their funds in the company or not. Clear? Like they know that basically A company basically going to merge with the B. Clear? Now they have the option, clear, whether they have to retain their funds or not. Alternatively, they may choose to retain their shares. If the SPAC needs additional finances to complete a merger, it may choose to issue the debt or additional shares through a transaction known as PIPE, private investment in the public equity agreement. Alternatively, the SPAC may sell their additional assets. Clear? Basically to raise the additional funds. Clear? There are like either through the debt or through the PIPE, or even they can sell their additional assets to get the money. So this is the typical SPAC timeline. Life cycle up to 19 months. So here that is formation and IPO phase. Proper, this is to mention here, that is target search, then negotiation, agreement. Either it will be in the yes or it will be the no. It will avoid overlapping. It will, so investor meetings and shareholder votes. Clear? If there is an agreement, clear, investor meeting, either it will be approved or not approved. Clear? Not approved, then they will go start again searching. If it will be approved, that is closure of the SPAC, that is to be known as the de-spacing. Okay? Or wind up SPAC and return investor to the shareholders. Clear? If they are continuously searching and time period it is completed, so they have to return the money to back to the investors. Clear? So this is the, so basically for the illustrative purpose, the SPAC life cycle presented it is based on a 24th one timeline basically to complete a merger. Clear? So this is the, just for the understanding purpose, they will, that is target search negotiation. Either the agreement basically will be approved or not. Clear? If it is approved, then the investor meeting and shareholder vote, whether they want to retain their funds in that company or not. Clear? It depends upon that. Clear? If there is approval, so that is de-spacing. Clear? It is a technique of the merger. Okay, and if they are continuously searching and time is to be completed, that is to be known as the, they have to refund back the amount to their basically investors. Okay, so all these things basically it is to mention here. Clear? So in this session, basically we have to cover up to this much point. Hope all of you are able to understand all these points properly. In the next session, basically we will discuss further and I will upload the additional sessions clear on other topics also. I request to all of you go through the sessions side by side and attend the MCQs in the group. In the next session, we will cover the space merger, SPAC merger, stakeholders, sponsors. What is the process, completion of that? All these things basically we will cover up to this much point. Clear? SPAC capital structure in the third part we will have to cover. Okay, maximum basically 3 sessions basically we will take to cover this chapter. So thanks to all of you for joining this session. Definitely you will get 3 to 4 questions basically from this session, from this chapter.